Yeah, the Bank Monetary Policy Committee actually meet today. They make that announcement at midday tomorrow. And what are they focused on? Well, this green line here, this is consumer price inflation, 2%. This green dotted line is the Bank of England's target rate for inflation. We can see what's actually happened. So we ran through the cost of living crisis post the Ukraine war, this up nearly 12% CPI inflation reached. It's now fallen back down. We come down the other side of the mountain, hit 2% in June, in July, and again in August, the figure confirmed this morning, 2.2%. So inflation rising a little, which is something the Bank of England is thinking about. They expect it to come to 2.7%, but we can have a look at the numbers underlying this small increase in the inflation figure. We've got another chart I can show you now, which breaks down what makes up these numbers. Now, that red line on the last screen is now the green line. That's the core CPI line of inflation. But there are a couple of things going on here. Goods inflation is actually falling. So the cost of your basket of goods at the supermarket and the like might not feel like it, but it's actually deflation, minus 0.9%. So goods are actually getting cheaper. They're not just rising less slowly, but services, which make up 80% of the British economy. That's everything from buying a coffee to university to city financial services. They're still rising, up above 5%. And services inflation is pushing up core inflation. When you strip out from the main inflation figure the volatile things like fuel and food prices, which depend on commodities, which go up and down, you're left with core inflation, 3.6%. It rose again in August. And that is what the Bank of England is worried about. They're worried about the underlying lasting effects of inflation, mainly reflected in wages that increase to keep up with prices, that they are causing inflation to be sticky, as you might say, in the economy. The price shocks of fuel and food inflation and the labour market squeeze, they've moved on. The economy's recovered from those, but there's a bit of core inflation stuck, which is why they're cautious about decreasing interest rates too quickly. So we had a cut at the last meeting of 0.25%. The markets think it's only a 1 in 4 chance that rates will be cut again tomorrow. Expect them to be held at 5%, with the expectation being there will be a cut at the next meeting in November, and then rates will fall. That's by the end of next year to as low as 3.5%. This evening in the US, the Federal Reserve, the central bank there, will cut interest rates. That seems certain. The only debate is whether it will be a 1/4 point or a 1/2 point. We had the European Central Bank cut rates last week. So we can see across the developed economies, central banks think they're winning the fight against inflation, but it's not done yet. So they are starting the process of cutting rates, relaxing their policy. They'll allow people, give people effectively more money to spend, but they are worried that if they do it too quickly, more money floods into the economy, this core inflation number will go higher. What they're aiming for is a soft landing after a very rough few years for consumers and the economy.